The election is just a few days away, and many investors are preparing for what is going to happen in the future. There are many different opinions for how you should approach election years, and I just wanted to make a video to share with you my thoughts and what I'm doing these next few days leading up to the election, other than golfing. Hey everyone, thanks for joining me today. My name's Matt, and as I mentioned, today we're going to talk about what I would do for the election year, and I just have to say, not advice, please don't take it as advice, speak to an advisor, or have your account managed if you do need advice. This is just all my opinion. And yeah, it's Sunday, not my typical day for uploading, but figured we had an extra hour today, so might as well make a video, and also if you haven't already, change your clocks and change out the batteries in your smoke alarm. Little homeowner tip right there. Now, I think this video might be a little bit on the long side, so I just want to get right to the point here and lay out for you exactly what I'll be covering in this video. The first thing I want to talk about is the history of the stock market during election years. Then I'll talk about what I'm doing to prepare for this election other than going golfing. Then we'll talk about how I would make any changes to my portfolio. And then lastly, we'll finish it off with showing you how to find, or how I would find, maybe some potential investing opportunities in the future. So starting with the history, and this may actually come as a surprise to many of you out there, but elections don't actually carry that much weight or have that much of an influence on the stock market. I found this chart from capitalgroup.com, and I'll put it up on your screen so you can see this here with me. And it shows basically the value of a $1,000 investment in the S&P 500 from 1938 to December 31st of 2019. As you can see from this chart, if you just put in that $1,000 and never sold anything, regardless of who was in office, it trended upwards, which is a really encouraging thing to see. And why is that the case, regardless of which party is in office? Does it still continue to trend upwards? And that's really because there's a lot of other factors that carry more weight into influencing the direction of the market, other than just who is in office at that point in time. A few examples of events or circumstances that do typically carry more weight on the market itself would be things like natural disasters, so think of like Hurricane Katrina, diseases, kind of like what we have going on right now, wars, terror threats, or anything that really has just a major impact. And usually it's factors that cannot be controlled, if you couldn't tell by that list. But now you might be asking yourself, well, then why have we seen so many red days in the past week or 2 weeks? And one of the biggest reasons behind that is because investors do not like uncertainty. Without knowing what taxes are, interest rates, minimum wages, policy changes, all of that good stuff, investors will typically feel more confident putting their money into a money market fund or cash reserves until they have more definitive answers or a definitive outlook for what the future looks like for them. And without really getting into the economic side of things, this is really supply and demand at its finest. So part of the reason why we might have seen a bunch of red days within the past few weeks is because investors are starting to make that transition into those money market funds. And again, supply and demand here. So as people sell out of these positions or stock positions, that's going to increase the supply. But if the demand isn't there, it's going to drive down these prices, which again is why you've seen some of those red days. Not the entire reason, but it's why, companies were reporting earnings last week, but they were still headed down. And that's because people are trying to become a little bit more conservative and moving out of the risky assets that stocks are. Now, from another chart I got from capitalgroup.com, you can actually see that the year following the election is when people actually dive heavily back into the stock market. And that's because they finally have a little bit clearer picture as to they'll know who's in office, what changes they plan on making, and ultimately just finally understand what their futures looks like to the best of their ability. And again, what we'll see at that point is when people are going back into the market, we're back to economics here. And so as people go back into the market, the supply is going to decrease and demand is increasing as well, which means you should be seeing an increase in the stock price. That's why you'll commonly hear people say that the market itself generally goes back to exactly where it was pre-election, around February, March of the year following. And that's because investors are starting to get back into the market, which again is bringing those prices back to where they were pre-election. It's not all the time. Not everybody says that. Not everybody agrees with that theory, but it is one theory out there that you'll hear why, again, the market tends to balance itself out. Otherwise, without getting into it, kind of the efficient market hypothesis. So what am I going to do to prepare for this election? And the answer is really nothing I haven't been doing already. I'm still going to buy into companies that are healthy, have strong balance sheets, I think have really good leadership, don't have much exposure to macro factors that can influence the company's performance, and overall companies that I believe are leaders in their space. That's why that's been my investment philosophy, because companies like that shouldn't really be affected by who's in office. And you could ask a question of things like, well, what about like tariffs or taxes, or if minimum wage were to increase, shouldn't that have any kind of factor on the companies itself? And in theory, I see where your thought process is, but that's where I'll just give the example here. In my Watch This Wednesday portfolio, we own McCormick, the spice company. And I really don't think that whoever wins this election is going to stop me from seasoning my chicken. Ultimately, McCormick is going to be a company that has a high level of demand regardless what's going on with the political factors. So that's why I invest in companies like that. You can even say the same thing about a company like Ecolab. Especially right now, doesn't matter who's going to win the election, commercial spaces are still going to need a cleaning supplies. Now, Ecolab has a little bit more of an international risk factor tied to it, but again, doesn't matter where you are in the world, a lot of people are now going to be focused on cleanliness, and Ecolab just fits right into that category perfect. So those are just two examples of companies that I am not concerned about with who wins the election, because their demand will still be there regardless. You might also notice though that I don't have any health insurance companies in the portfolio, and that is also intentional. And that's because those do have a little bit more of an influence with political factors, and depending on who wins could actually influence the performance of those companies. So that's always been my mindset, is I invest in companies that regardless what's going on in the world, Verizon, Waste Management, Ecolab, Adobe, McCormick, Apple, those are all going to do fine regardless who's in office. But that's also why I like investing in companies that have a little bit deeper roots as a company itself, because that shows that they've been able to weather the storm regardless which party or regardless who's in office. They've been able to remain profitable, and that just gives me a little bit better peace of mind knowing that I'm investing in companies that have experience with multiple different types of leadership. Now, if I did need to make changes, how exactly would I go about that? Well, that's what I want to talk about here in this section. So let's assume that you've already built up a decent sized cash portion in your portfolio for any opportunities that might come around. This time is what I would use to do your research and find companies that might be trading at a little bit of a discount, or maybe you'll have a better buying opportunity than you did either 6 weeks ago or 6 weeks from now. When it comes to cash in my portfolio, I generally keep around 5% of my portfolio in a cash position. Again, in case an opportunity presents itself, I want to make sure that I have some cash ready to go to purchase it without the need of selling out of any stocks. But during times like this, or during election years, I can say that it might be a good idea to increase that cash portion to maybe around 10% or so, just again, because we know markets will be volatile during times like this, and a good buying opportunity might present itself. So if you have more in cash right now, that could actually be a good thing, because you can get a larger exposure to a company trading at a discount than really you could at other times. And as I mentioned, the goal here is not to sell your investments, because we have that long-term mindset. But should you need to sell any investments that you currently have, there's a way that I go about it that I wanted to share with you. So I'm going to pull up here the Watch This Wednesday portfolio so I could show that with you. Okay, so here's the abysmal Watch This Wednesday portfolio, the one that has not been doing too well recently, but that's okay. And the easy thing to do here would be to just sell out of the biggest gainers that we have, because those are the ones that have already made us the money. Problem with that thought process, though, is that means that you would have a lot in capital gains taxes to pay, and that company could be on a good run still, and could still have a lot of momentum pushing it forward. When I do need to sell out of positions, what I like to do is just take a look at the gains that I have. And so as you see here, I just sorted everything by the gains in the portfolio. And I like to look around probably between these regions. So anything that either has a loss of less than 100 or gained less than 100. So really between negative 100 to positive $100 in it, because those are ones that really haven't been movers. Or as I like to say, those are my stagnant positions. Depending on how long you've been invested in them, that's a factor as well. But to keep it simple, we're going to remove time from this. And so if I needed to sell out of a position, I would really be looking at companies, again, disregarding time, maybe Apple, Activision, Spotify, 3M, Verizon, and Waste Management. The other ones are just either too far deep and we don't want to sell out of those because, again, that's basically throwing money away if you're too far in the red, and too high in the green could be a capital gains tax that could hurt those gains that we just got. So I feel like within that $100 range is kind of a sweet spot for it, because that just, again, helps make sure we're not throwing money away that could come back to us in the future, but also not going to have that money be eaten up by taxes. Now, I would probably pick the ones that I feel just are going to remain steady anyway. So in this example here, I would probably sell out of the Activision position and the Spotify position. Not investment advice. Again, this is still not investment advice. Reason being is because, Apple, I still think is going to be such a strong company for the long run. I've just watched that company go up, split, go up, split. So one I wanted to hold on to. 3M, great company to have as well, as we've shown that they don't really have much competition. They're just a great company with a good paying dividend. And really the same for Verizon and Waste Management. So again, showing it that way, I'm looking at things of how long have I had these positions, how much have they either gained or lost me, and hopefully it's pretty minimal amounts, but do they also pay a dividend? And if they pay a dividend, it's a strong dividend and it's a company with a good track record, or as we call it, a dividend aristocrat, those are ones that I want to keep in the portfolio. And that really does just leave behind Activision and, what's the other one? Spotify. So since neither of those two, does Activision pay a dividend? Yeah, Activision pays a dividend, but it's a really small dividend. As we could see here, it's only dividend yield of 0.53%, so about 0.5%, and Spotify does not pay a dividend. So those are the ones I would probably sell out of, just if I felt that there was a good buying opportunity around the corner and wanted to have cash ready to go, assuming I didn't have anywhere from 5 to 10% of my portfolio already in cash. So again, my thought process there is don't look at the ones with the big gains or the big losses, because that's how you can shoot yourself in the foot. Look for ones that have been pretty stagnant since you've purchased them, assuming you've held onto those positions for longer than 6 months to a year, we'll call it. And this kind of brings us to the next part here. So how do you find companies that could be undervalued, or keep ones on your watch list to keep an eye out for, hoping that there's a good buying opportunity? And that's what I'll show you next using Yahoo Finance. Okay, so the reason why I'm using Yahoo Finance is because I'm assuming that's the one probably most of you have access to. I would actually use Simply Wall Street for my screener as opposed to Yahoo Finance, because that's the service I use the most. But again, most of you probably use Yahoo Finance and are familiar with it. So what you do is you go to these screeners. We want either an equity screener or an ETF screener. I could not talk today, I apologize. And I'll say this too here real quickly. If you're not sure how to kind of go about this, or if what I'm about to say goes right over your head and just not something you'd really be interested in learning, there's nothing wrong with buying a broad-based index fund, whether that be like Vanguard's total stock market or a technology index fund at QQQ, VGT, anything like that is really okay to own as well. Again, if you're not really wanting for the individual stocks. Most of my personal portfolio is actually in ETFs. I don't actually own too many individual securities, but I like stocks. That's what most of you out there like, I can tell. So we'll just focus on the stocks today. Keep in mind though, don't like this, you can always look at ETFs. And so, for me personally, just kind of at random here. So region, United States, whatever. We'll go with, we want a mid-cap company. I don't really care about sectors. Let's go add another filter. So the filters I'm going to use, I would love to do the estimated revenue growth, but that's a paid feature, so I'm not going to do that. What I want to see here is the 1 year % change in EBITDA, which again just shows how good they are with their cash management, or their cash flow from operations is what EBITDA shows. We'll want a quick ratio in there, and we'll take a look at the trailing PE. So this is just going to be a really simple search here, but I feel like I like to cast a broad net and not use too many different filters, because then I won't get as many results. And sometimes you could just be off by like 0.01%, and that'll show you a stock, or it won't show you a stock that could have some great potential. So I only like to just choose a few of these, and feel free to play around with them as well to really help find a stock that's best for you. But just don't go click happy and check all of these off with different numbers, because you'll get 0 results. I guarantee I already checked too many of these, and we're probably not going to get the best results anyway. So as of now, we have the potential for 232. Just watch how quickly this drops. So I think that if they had an EBITDA greater than, we'll call it 4%. A quick ratio. I want a company right now, if it's going to be volatile, with a strong balance sheet. So I don't want them to have too much debt, and I definitely want them to have a quick ratio over 1. So for that, I'm going to go with 1.45, greater than 1.45. And I want this PE to be low. So I want the stock price to be pretty relative towards what their earnings are. Not looking at a Tesla with an 1100 PE ratio or other companies out there with like a 700 PE. I'd rather keep this one here maybe between 0 and 20, which gives us 47 results. Not that bad. I actually expected way less than that. And we'll go find stocks. And then you just kind of look through here. Now, this is a lot to sort through. So if it's too much or if this is too intimidating, feel free to use more filters. 47, I actually feel like is a good place to start working with. And then you could change it here. Are you after more smaller cap, the PE ratio, whatever floats your boat. I actually don't like that they do the 0 to 20. I wish they did a 1 to 20 for the PE ratio, because 0 could mean they don't have earnings, and that's not what I'm looking for right now. I am looking for companies with earnings. So, personal opinion there. But, from this list, most of these companies probably haven't heard of. It's because they're mid-cap companies, so they're not the ones everybody's talking about. Valvoline, perfect example. So, Valvoline, the oil changing company. Maybe I'd look into this company's financials from here, see that their 52-week high is 23. Maybe not the best example. So I did this earlier, and I apologize. BJ's didn't come up when I did it last time for that screener, but I did this earlier just so I can kind of run it before filming it, and BJ's came up. And this is one that caught my interest because wholesale clubs tend to actually do pretty well in times that, where the economy is a little bit down, because it's a place to get a little bit more value for your money. Membership costs, I know it's a little debatable there. But as we can see here, just taking a quick look, earnings, they've been killing it with their earnings recently. We don't really care about what the analysts say, but in case that's something you're after, it has a 2 rating of a buy. Beta of 0.45, so not a volatile stock at all. A PE ratio of 17.7, that's perfect. I would have to see what Costco's is, though, just to make sure that's about in line with what we can expect. And earnings per share at 2.16, does not pay a dividend, that's fine. 52-week high is 47, currently trading at 38. So this looks like an opportunity to me. This is something that I would add onto a watch list, and then for the next few days, what I would do is research this company to see, what's their advantage, competition, who's leading this company, how strong is their balance sheet itself, and then make the decision or kind of figure out what price I would buy this at. So that's what I would use this time for, and that's how I use these screeners to find these stocks that I do for the Watch List Wednesday. Obviously, I use Simply Wall Street, so it's a little bit different, but just an example in case you weren't familiar with how to use those screeners, and I hope that was helpful for you. Again, too, regardless what happens in the election, you should be investing for the next 10, 20, 30 years. During those time frames, you'll see multiple presidents. So don't worry about what's going to happen for the next 4 years. Worry about yourself first, and how safe are you with your investments, and how comfortable are you with it, moving forward. So don't let this election, in my opinion, carry too much weight towards your investment philosophy. Don't make any rash decisions and just act impulsively because you don't like the outcome of the election, because that's not responsible investing, and that's exactly the opposite of what I try to teach here. So with all of that said, this is how I'm approaching the election. And again, it's not much. I'm not doing much because I don't care. I don't invest in companies that will be influenced by this. And that's just my personal investment style. Other people out there might have different approaches, especially too if you're a short-term investor. I'm sure that this election carries a lot more weight than it does for somebody like myself who has such a longer outlook. So I hope this video was helpful for you, and I hope that you enjoyed it. If you did, hope you hit the like button. And remember, all the kids these days are subscribing to my channel, so if you want to be cool like them, I suggest you subscribe as well. With that said, though, I don't really know what else to say. It's a rainy day, and we have an extra hour today, so I'm going to try to wrap up here. Thank you so much for taking the time out of your day to watch this video. You could be anywhere in the world, but you're right here with me, and I really appreciate that. I'll let you go ahead, enjoy the rest of your day, and I'll see you next time.